there appears to be yet another storm brewing in the housing market. Lenders who hold trillions of dollars in mortgage debt aren't necessarily making it easier for struggling homeowners to rework their second loans. And our next guest says that the government program to provide some mortgage aid to those people with second loans is actually falling short of its intent. Will this lead to a spike in foreclosures? Well, we're asking one of the top mortgage bond analysts who was recently inducted into the Fixed Income Analyst Hall of Fame. That's Laurie Goodman. She's Senior Managing Director at Amherst Securities Group. Thank you so much for coming in studio for us today.
Thank you very much for having me.
Now, I've read a number of your reports here, amazing analysis here in terms of the granularity of some of these government programs and you finding in fact, some loopholes, or really where they fail to meet their intent in terms of stopping some of the losses that are threatening those with second home mortgages. Tell me why the government program is falling short here.
Sure. In order to have a successful modification program, there are two things you need to do from the borrower's point of view. The first thing you need to do is you need to cut principal. And the Treasury's program that's going to be instituted in the fall does exactly that. The alternative waterfall is meant to cut principal on these loans. The second, on the first mortgages.
On the first mortgages.
On the first mortgages, but on the second mortgages, according to the Treasury's own estimates, over 50% of these distressed borrowers have second mortgages. There is no operational second lien modification program yet. There was a plan proposed.
So these are the people who are using their homes as ATMs. The first mortgages that they had, where we were very focused on with the crisis, that's being addressed. But that second, that pile of mortgages they have is not.
Right, and the second mortgages make a huge difference in terms of the performance of the first, because you're looking at the total combined loan-to-value ratio of your home when you're deciding whether or not to continue your payments. You're looking at the total indebtedness. And the other thing is you're also looking at your total debt burden. So what the Treasury has done is they've addressed the first mortgages and they've addressed the so-called front-end debt-to-income ratio. That is how much the borrower spends on taxes, insurance, and the first mortgage. So most of the modified loans have brought down the front-end debt-to-income ratio on average from 45% to 31%. The problem is that you haven't really addressed the borrower's total debt burden. That is the taxes, insurance, first mortgage, second mortgage, auto payments, credit card payments, etc. That is still at extremely unsustainable levels. On average, you've brought down the borrower's back-end debt-to-income ratio from 76% to around 60%, which is still unsustainable.
So why is it that this hasn't been addressed to the degree you'd like? I mean, you say what measures are there haven't really been acted upon in a quick manner. There's too much of a delay. There are too many overlaps.
Yes, I think the biggest problem is that the largest holders of second liens are also the servicers on these private label securitizations,
so
and also on fan. So it's certainly not in their interest. About 40% of all home equity lines of credit and second liens are held by the top 4 financial institutions: B of A, Wells, JP Morgan Chase, and Citi.
And I believe we have that we can put up for our viewers. I believe the screen that you're referring to there. So Bank of America, JP Morgan, Citi, these are the banks are also
yes, they control 56% of the servicing of 1 to 4 family loans. They own 40% of the seconds. It's not in their interest to write down the second. So their ideal is to have the first modified and where someone else owns the risk, and have the second still outstanding and unobstructed.
So what you're telling me, and correct me if I'm oversimplifying this, is that these banks who already had toxic loans on their balance sheet, those are being addressed. But that second round that they've got there is being completely ignored at this point.
That is correct. There is a second lien modification program that they are coming up with guidelines for, but it is just taking forever. And they are doing everything they can, and it seems like there are a lot of things in that modification program that will actually not be in the borrower's interest, nor in the interest of the first lien holder. So, for example, there is a long delay between when you modify the first lien and when that second lien gets modified.
So, bottom line, housing could actually be worse than what we think it is, and the government could end up owning more homes than they already do. more foreclosures.
You need a successful modification program to get us out of this, and unfortunately, the second liens are being addressed in a manner that is bound to fail.
All right. Thank you so much, Laurie Goodman, for coming in and explaining all this. It's something we're going to try to keep our eye on, this storm looming on the horizon. I appreciate that.
Well, thank you very much for having me.